Recently, estimates from Galaxy Research suggest between $40 and $70 million in Bitcoin was drained from cold card hardware wallets in a single exploit. Without federal oversight or mandatory security standards, retail users caught in these hacks find themselves in a regulatory vacuum with no clear path to recover their assets. While users take the risks of self-custody, legacy banks, represented by figures like Jamie Dimon, continue to lobby against rules that would allow crypto firms to compete for stablecoin deposits and interest yields. This creates a lopsided environment where retail investors carry the burden of security failures, while traditional institutions use the lack of rules to protect their own market share. Addressing this imbalance is the central goal of the Clarity Act, a piece of legislation that has been in development for over 5 years, but the window for its passage is closing fast. The Senate has only a few working days left before the high-stakes August recess brings all legislative movement to a halt. Senator Cynthia Lummis warned her colleagues that if this bill does not move forward now, the next realistic opportunity for market structure reform won't materialize until at least 2030. This multi-year delay would likely drive domestic crypto firms to move their capital and technology to more receptive markets in Europe and Asia. Failing to act before the deadline risks a long-term exodus of investment, ceding the development of next-generation financial technology to international competitors. Despite growing to 700 pages to satisfy law enforcement and DeFi critics, the bill remains in a state of gridlock on the Senate floor. Overcoming a filibuster requires 60 votes, meaning Republicans need 7 to 10 Democratic holdouts. Their opposition centers on one demand: strict ethics standards to prevent sitting politicians from profiting from the digital assets they regulate. Senator Elizabeth Warren has been the most vocal critic, arguing that regulating the market without banning personal crypto holdings creates an inherent conflict of interest. Much of the debate focuses on Donald Trump, with critics pointing to his family's recent crypto ventures as the reason these ethics rules are necessary. A global market bill intended to secure billions in assets is currently stalled because both sides cannot agree on how to police the personal investments of elected officials. In a final attempt to break the deadlock, a new bipartisan ethics provision has emerged as the August deadline approaches. Senators Tom Tillis and Ruben Gallego co-authored this proposal, aiming to create a middle ground that restricts the financial activities of lawmakers and the president. The deal proposes mandatory blind trusts for federal officials and gives state attorneys general the authority to investigate potential violations within their jurisdictions. This compromise draft was delivered to the White House this morning for a final review. If the president signals his support, this document provides the specific concession needed to secure the 7 to 10 Democratic votes required to bring the bill to the floor. All attention is now on the White House. The administration's response to this single ethics clause will determine if the bill moves forward or dies. If the deal is rejected, the U.S. crypto industry faces a 6-year wait for federal rules, leaving the market in its current state of retail vulnerability and bank-led gridlock. If approved, the Clarity Act becomes law, establishing the first comprehensive federal framework for the digital asset industry. This would trigger a transition from the speculative era of early crypto into a strictly regulated environment suitable for large-scale institutional use. The decision on this ethics provision determines whether the United States remains in a legislative vacuum or finally opens its financial rails to regulated blockchain technology. A successful vote would likely signal a new phase of adoption, as institutional leaders like BlackRock's Larry Fink prepare to move trillions of dollars in real-world assets onto blockchain rails. With federal rules in place, cryptocurrency would shift from being a fringe asset class to becoming the underlying software architecture for global finance. It is a striking reversal for an industry founded to bypass centralized systems. Its survival now depends entirely on receiving formal permission from those same institutions. The future of decentralized finance currently rests on whether the world's most powerful centralized government can agree on its own internal code of conduct.